Hi, and welcome to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson from OTG Capital. We broadcast locally on Radio Northern Beaches here on the sunny beaches of Sydney and around Australia on the Community Radio Network, compliments of the Community Broadcasting Association of Australia. We're always really pleased. We've got about 14, 15 regional stations now that pick up the show. Thank you for listening. Thank you for the odd occasional email and comment that we get. Always appreciate it. We're really pleased to welcome back to the microphone and our screen Stuart Sherry, who is a subject matter expert on superannuation from the Institute of Financial Professionals of Australia. Welcome back, Stuart.
Thanks, Ray. Good to be back.
Wonderful. Now, it's a little bit of news, Stuart. We're really sad that we're losing Natasha Panagas. Natasha has been on the show on many occasions talking about superannuation as well. I guess I'm just surmising you're going to be taking on a lot more then, I guess, with Natasha moving on. But again, ladies and gentlemen, Stuart is equally as qualified as Natasha and, again, very, very knowledgeable in this space. So, Stuart, this time around, we've had Natasha previously on the show just before the big annual conference talking about the rise in caps because of indexation. So, the transfer balance cap's gone up, the contribution rates have gone up, the superannuation guarantee rates have gone up, and we've also got payday super coming in on the 1st of July. So lots and lots and lots of changes. But having read the precursor to the show, I'm really excited about the show because this stuff actually really relates to me. So I've read it with interest. But this one really comes down to all of that information that Natasha had imparted to us, but then comes back to timing. So ladies and gentlemen, we're referring to, and we'll put on our website these slides, but super contributions and pension planning. So it's one thing having the data and the information, but Stuart, you're going to talk to us all about planning, aren't you?
That's right. So there's some decisions that's going to need yourself and other people who are looking to contribute or start a pension. They're going to have to start thinking about some strategies between now and 1 July because, as you mentioned, a lot of those rates and thresholds are changing. So there could be opportunity in doing things now or maybe delaying contributing or starting a pension, leaving till next year.
Now, I think it's really valid for our listeners and viewers right now to understand this is not just about people that have got larger balances, and I'm talking again, when you think about the average superannuation balance, which goes across all ages, it's about $200,000 or $300,000. We're talking about people that are now close to retirement, but a lot of people haven't had the benefit of being able to accumulate a lot for a whole bunch of different reasons. So this can apply to people with balances below $500,000 and those that have above and also beyond the Div 296, which we've talked a lot about as well. So we're seeing these significant changes. I guess, can you give us a quick overview of what's changing and why advisors should be paying attention right now?
Okay, so let's start with pensions. There's what we'll call the general transfer balance cap. And what that says is it puts a limit on the amount of money that you can put into pension phase. So currently that's $2 million. So if you've never started a pension before in your life, you can, and you've got $2 million in super, you can transfer up to $2 million into pension phase. Now that's going up to $2.1 million on the 1st of July. And that's called the general transfer balance cap. So you've got a decision today. If you've perhaps got $2.1 million in super today, do you start a pension now or do you wait until next financial year when you could potentially get it all into pension phase? Then we have the contribution caps, which you mentioned. They're also increasing. So the non-concessional contribution cap, so that's where you're not claiming a deduction on personal contributions into super. Well, that's going up from $120,000 a year to $130,000 a year. So that's increasing in the new financial year, as are the concessional contribution cap limit as well. So that's going up as well.
So again, one of the things that I think is staggering a lot of people because of all these changes, when we're talking about these sums of money and the potential to be putting in after-tax money as a non-concessional compared to the super guarantee, why is timing important?
Timing is important in the context of, say, non-concessionals, because we have what we call the bring forward rule, right? So if you have a total super balance below a particular threshold, you can put in up to 3 years worth of non-concessional contributions in a particular financial year. So, for example, if you this year the non-concessional contribution cap is $120,000. If you were to put in $121,000 into super, you will trigger the 3-year bring forward rule, meaning you're locked in for the next 3 years in contributing no more than a total of $360,000 in total. Whereas if you were to trigger it in the new financial year, when the non-concessional contribution cap is $130,000, you can put in up to $390,000 over the next 3-year period. So what you might want to think about doing is perhaps only contributing $120,000 in the current financial year, not triggering that bring forward rule, and doing it in the subsequent financial year.
Okay, so when you're talking about triggering things, so this is where you notify, let's say, for example, if you have your own superannuation fund, or you're in a industry super or a private super fund, you notify them of what you're going to do. Is that correct?
No, interestingly enough, you don't need to do that. So the super fund doesn't need to know. You just make the contributions as you would ordinarily. It's the tax office that knows. So let's just say, hypothetically, I were to put $500,000 into super today. The super fund's not going to tell me I can't do that. They'll welcome me. They'll say, well done, put in.
I'll say thank you very much.
Take the money. Thank you. But the ATO, they'll say, Stuart, you put in a little bit too much that financial year. You've exceeded your non-concessional contribution cap, and they'll give me an option. They'll say, do you want to withdraw that excess amount, or do you want to leave it in there and have it taxed at the highest tax bracket? And so more often than not, or rather, you'll be hit with a higher the top tax bracket on that excess amount. So that's generally not a good idea. So you can make the contribution, but there'll be penalties if you exceed the caps.
Okay, fair enough. So with these increases in the concessional caps, again, I'm referring to the slides now, this increase has additional flow-on effects. What are those flow-on effects?
Yeah, so we've been talking about the non-concessional contribution cap going up, and the reason for that is because the concessional contribution cap is going up. So the non-concessional contribution cap, to get all technical, is 4 times whatever the prevailing concessional contribution cap is. So, for example, at the moment, the concessional contribution cap is $30,000. 4 times that is $120,000, meaning you can make a non-concessional contribution of $120,000. Now, the concessional cap is going up to $32,500 next financial year, and 4 times that is $130,000. So that's why there's that flow-on effect to the non-concessional contribution cap.
And that CC again relates to SG payments, doesn't it? So
yeah, so SG is a form of concessional contribution. So concessional contributions are generally those contributions for which someone's eligible for tax deductions, whether that's the employer by way of super guarantee or personal deductible contributions. They count towards your concessional contribution cap as well.
Okay, so one of the things, ladies and gents, we'll put these slides up on our blog, but the threshold and caps for 25, 26, and then beyond 26, 27 are listed there. But the basic line is, instead of 2 million, it's now 2.1. I think is the key number.
That key number there, yeah, that's what we call the general transfer balance cap. That's going up to $2.1, and that is linked, if you like, to your eligibility to make contributions into super. So what they say is, if you've got $2 million as at 30 June of the previous financial year, you're not eligible to make a non-concessional contribution. Okay, so next financial year, because that cap is going up to $2.1 million, what they say is, if you've got a little bit less than $2.1 million in super as at 30 June 2026, then you can make that non-concessional contribution of $130,000 into super.
So if I move on to your next slide now, you're saying triggering the 3-year bring forward now. You've just made mention of just earlier in our discussion. So we've got 360 available to us right now if we were to trigger the 3-year carry forward rule. But yes, you're also saying potentially it may be worthwhile to hold off and maybe do one right now and then wait until the 1st of July when the rate goes up, and you can then put in more from there on.
Yeah, like in that scenario, you could potentially put in up to what, $510,000 if my math is correct. So that would be $120,000 this financial year. Trigger it in the new financial year and put in another $390,000. So if you've got a large amount of money, you might want to delay that triggering that bring forward amount.
Okay, so again, there's a really good case study here, ladies and gentlemen. Again, that'll be in the slides. Maya, age 70. And again, this contribution as an NCC is important because the tax has already been paid. And, this is something that we've spoken with you and with Natasha in the past at IFPA, that NCC component becomes very, very important should you pass on, and then your people that are getting the benefit of your super, there are tax implications around that as well. That's for another show. We've covered that off before, and I'm sure we'll cover it off again. It's just one of those things. So covering off the bring forward and the TSB thresholds need to be looked at. And again, depending on the complexity, Stuart, this is the kind of thing that you'd recommend that if you've got quite a lot there and your needs are complex, that you go and talk to a financial advisor.
Absolutely, particularly getting those thresholds right. So, if you have too much in super, you cannot trigger or make a non-concessional contribution at all if it's above $2 million as at 30 June 2025 for the current year. The new financial year, it's going up a bit. So yeah, absolutely get advice because it can get quite tricky, those thresholds.
Great. Look, we're just about half time for part one of this session that we're taking up with you. We're going to talk about catch-up concessional contributions after the break because, again, that's, again, of great interest to me, but I'm certain it's going to be to a lot of our listeners. You're listening to Dollars and Making Sense, a weekly show about finance, money and investing. I'm really pleased to have at the microphone this week Stuart Sheary from the Institute of Financial Professionals of Australia. He's a superannuation subject matter expert. We're going to take a short break and we'll be back with you in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels or email. Please search for Dollars and Making Sense in your favourite podcast platform or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson. I'm really pleased to have at the microphone and screen this week Stuart Sheary, subject matter expert on superannuation, and he is with the Institute of Financial Professionals of Australia. You may know them as the Old Taxpayers Association. This is an organisation, ladies and gentlemen, that have been around for over 100 years. They've got over 4,000 members, and you'll see them as predominantly tax accountants and tax agents. I was really pleased to be at their annual conference just recently and really, really well attended. And Stuart, I know you were presenting a lot of information and we are catching up on some of this because we've had other people from IFPA on the show talking about the caps and the rates that are going up for superannuation from the 1st of July. And before we went to the break, we were talking about strategically timing non-concessional contributions. So this is after tax money that comes into your super. And again, given that the TBC is going up on the 1st of July, people may want to pause and maybe not breach that 3-year go forward rule because holding off to the 1st of July could be in their interests. Now, the next thing we're going to do is talk about catch-up concessional contributions. First of all, can you explain 1.01? What are catch-up contributions all about?
It's kind of like the opposite to the bring forward rule in the sense that we're going back in time. So we've not used our full concessional contribution cap in the past, And the government has kindly allowed us to go back in time and use those unused amounts in any time in the previous last five financial years, so long as our total super balance is less than $500,000 as at 30 June of the previous financial year. So let's just say 3 years ago, I didn't make a concessional contribution into super at all. And let's just say, hypothetically, I forget what the concessional contribution cap was 3 years ago. Let's just say it was $30,000. Well, that would mean that I could potentially make a catch-up concessional contribution of up to $60,000 in the current financial year. Why? Because I've got my current concessional contribution cap of $30,000 and I'm able to use that unused amount from a prior year, assuming also that my total super balance is below $500,000. And so I can get a bigger tax deduction in the current financial year.
So let me ask a question here then. So let's say, for example, and I'm assuming that the balance is for the individual member. So if an SMSF has 2 members, it's not the total amount in there, it's per member. Is that correct?
Absolutely. It's per member. And also
So-
that means if you have an SMSF and you've got another super fund, well, you add those two balances together.
Okay, so let's say, for example, you are below the $500,000 limit, but let's say you go back the entire 5 years and you haven't been able to contribute because your SG payments hasn't been as high as it could have been. But let's say the second payment triggers you over 500,000. Are you allowed to make all 5 years, or does it stop at once you reach that 500,000 limit per year? I'm just curious. Or if you were to go, okay, I've got 5 years, I want to slam that all in one go, even though I've now gone over the 500,000 limit. Is that permissible?
What we're only interested in when it comes to TSBs is a snapshot of the value as at 30 June of the previous financial year. So if I have $499,000 in super as at 30 June of the previous financial year, I've got a lot of unused concessional contribution cap available to me, and I contribute $100,000. Well, yeah, I'm going to go way over $500,000, but the figure that matters is 30 June of the previous financial year.
Great answer. Thank you for answering that, because that was a thing sticking in my mind about it, because I'm going to be in that situation soon. And again, this then brings me to the next question that I personally have, and it's relevant, is that I guess timing now becomes really, really important, because let's say, for example, you're in the situation where you're doing downsizing, you're selling your family home. You don't want to put that into super first and pop your total over 500 if you haven't done your catch-ups just yet. Is that correct?
Brilliant point. Yeah. So you got to manage your total super balance, or think about it strategically when you're thinking about making contributions in the subsequent financial year. So let's just say you mentioned downsizer. Well, with downsizer, you've got to make the contribution within 90 days of settlement, of disposing of the property. So sometimes there's a window there, and that window might go over 2 financial years. There could be strategic advantages of delaying that contribution into the new financial year, because then it doesn't affect your total super balance. Because recall, the total super balance that impacts you is whatever it was as at 30 June of the previous financial year.
Okay, thank you for that. Thank you for that clarity. So look, we've got this excellent case study about Charlie, who is self-employed, made a modest capital gain on some sale of shares. His total taxable income is 300K, and he has a TSB below 500K. Now, he doesn't receive SG and has a minimal super balance. He's not made a CC in many years, and he's got 140K available as a personal deductible super contribution. Is this a good idea? I mean, this is, again, it's about timing and about strategy. So here's a guy that sounds like it's perfect, but is that necessarily the case?
Yeah, well, one thing in this case, crunching the numbers, it looks pretty good, but one thing to keep in mind is Division 293 tax. So we've been hearing a lot about Division 296 tax, which relates to high super balances, but we have a Division 293 tax, which applies to people of high income. And so in this scenario where you mentioned Charlie had taxable income of $300,000, if he makes a deductible contribution into super, then he may well be up for Division 293 tax, which is an additional 15% tax on concessional or low tax contributions going to super. So we've got to take that into mind for high income earners. People who have higher incomes, they might be up for an additional 15% contributions tax.
So this is now specifically the SG. So this is the 12% that gets contributed by his employer. Is that right?
No, a low tax contribution is generally concessional contributions
Right.
that are within the concessional contribution cap. So, in other words, excluding excess concessional contributions. So, concessional contributions, they include super guaranteed. So, yes, if he was earning $250,000 a year and getting super guaranteed, he'll be up for 15% tax on those super guarantee contributions,
Fair
unfortunately,
enough.
as it would be if he was making personal deductible contributions into super.
Fair enough. So Div 293, we haven't talked about that for quite a while. And I see here on your notes, Div 293 tax often catches people by surprise. So when you see this, what kind of real concern then that should our listeners have then?
To be aware of it, first of all. So generally, it can still be tax effective to make concessional contributions such as salary sacrifice or personal deductible contributions, even if you have a higher income. Why? Because, if you're on $250,000 a year, then you're on the top tax bracket is 47% if we include Medicare levy. So even though there's an additional 15% tax, we're probably still better off, but to be aware that there is that additional tax.
Okay, and again, ladies and gentlemen, I'm going to point you to the slides that you can download off our website, because there's a really good example here where by doing the correct partitioning, there's a good saving in tax payable. And again, I've got to stress, Stuart, we're talking about managing one's tax affairs. It's not tax avoidance, it's tax minimization. And you and I have talked about this before, but I think it's really, really important that people always consider.
Absolutely. But the dominant purpose here is to build our retirement wealth, not necessarily to get the tax deduction. So obviously that tax deduction is most welcome, but we're building wealth for all retirement, and we're looking for ways to get money into super the most effective way.
That's true. That's true. And again, we get some commentary, we get some feedback where, are we necessarily, purveying tax minimization or tax avoidance? It's minimization. Again, nobody wants to pay more tax than they should, but I'm not saying you shouldn't be paying tax at all. You should pay what you are fairly, apportioned and should be paying. Anyway, let's move on. Practical tips to managing. Now, this I really quite like as well. So practical tips to managing the transfer super balance. Let's talk a little bit about that. So TSB measured on 30 June of the previous financial year. We've covered a little bit of this. So can you explain a bit more about this?
Yeah, so as we've been talking about, you might want to delay those contributions into super until the new financial year. So, for example, we may want to delay triggering that non-concessional contribution bring forward rule. We might want to delay making that downsizer contribution until the new financial year in some scenarios. Another example might be if we've met a condition of release, we might want to consider commencing an income stream and start drawing down on our super, if that might help us bring that total super balance down. And that, funnily enough, might allow us to contribute more in by taking a little bit out.
Okay. And again, that relates to the TSBs being indexed and actually going up in that time as well.
And those thresholds, yeah. So, for example, if we had $2.1 million exactly, and we were to draw a small pension from our super, then that would allow us to make a non-concessional contribution in the new financial year.
Yeah, and I think part two, when we come back next week, I want to talk a little bit about some of these strategies as well, because this also brings to mind about recontribution strategies that we've previously talked about. But again, I'm just going to park that thought for the moment. Now, one of the most important things we've already been talking about, when we're talking about caps and limits and what you can and can't put in, what impact does the downsizer contribution have on these caps?
The downsizer contribution is great because it doesn't count towards the non-concessional contribution cap. So it doesn't impact your non-concessional contribution cap, meaning if you've sold your home and you're eligible to make a downsizer contribution, you could potentially put in $360,000 in the current financial year as a non-concessional contribution,
Mm.
plus the downsizer contribution of $300,000, meaning you can get a fair bit of money into super as a result of that fact that it doesn't count towards any of the caps.
Okay, so downsizer does not contribute in any way, shape, or form to what you're doing with your normal contribution strategy.
Correct. But just keep in mind, obviously, that contribution into super will increase your balance, which will affect your TSB for the new financial year.
Okay, and again, bear in mind, ladies and gentlemen, downsizer is a one-off. Okay, you only get it once, don't you?
Downsize is a once-in-a-lifetime opportunity. So if you sell your home and you make a downsizer contribution on that home, you can't then subsequently sell another home in a number of years later and make another downsizer contribution. It's only once you can do it.
Only once. So make it count and make it worthwhile for sure. Okay, we're just about out of time for today's show. We're going to be continuing this discussion, ladies and gentlemen, because it is so incredibly important given the time of year that we're coming up close to tax time and close to the end of this financial year with so many changes occurring in super with indexation rates and payday super and a whole bunch of stuff we've been talking about previously. Stuart Sherry, thank you for being on the show.
So much, Ray. Enjoy.
Wonderful. Until next time, ladies and gentlemen, adios from Dollars and Making Sense. We'll see you shortly.